Okay, everybody, we have 5 minutes before the show. I thought we would do a little preview here of a video that we wrote and produced, which became very famous. Oh, don't tickle me. And I'm going to show it now. It's done by a very well-respected Broadway actress, and it's on a topic that is near and dear to everyone's heart, and that is IRA planning.
A long, long time ago, when we could use a see-through trust for lifetime payments with great pride. And I knew that if I had my chance, that I could make beneficiaries dance and even be happy when their grandpa died. But the Secure Act made me shiver with the bad news it delivered. A 10-year payout required. I will be less admired. I can't remember if I cried when Natalie's book no longer applied, but something touched me deep inside the day the less than rapidly rule may have died. So bye-bye life expectancy sigh. The passing of the Secure Act left folks high and dry. Trust drafters all over drinking whiskey and rye, saying the at least as rapidly rule may not apply. The at least as rapidly rule may not apply. Do you know about our tax code and how all the laws have ebbed and flowed? If your advisor tells you so. While certain things might become wild, a trust will better protect your child, so they will have heat when there is snow. And I knew that IRAs had changed because my parents needed things arranged, but there's no need to sing the blues because neither have reached age 72. I can't remember if I cried when I read about example 5. Will the as least as rapidly rule survive when the life expectancy rule died? And so I'm singing bye-bye life expectancy sigh. Drove my Chevy Volt to the levee before the battery died. Those poor old tax lawyers were drinking whiskey and rye, singing today the life expectancy rule died. Today the life expectancy rule died. But I surely did not expect to see my Chevy crashed by 401A9B. We both had taken off our shoes, and I had my conduit trust ready to use. I knew that a couple we would be. I had fantasized about our RBD, but marriage would be required before that would be the day the stretch rules died. And now I'm singing bye-bye life expectancy sigh. I am lucky the Secure Act lets teapot trust apply. I have to revise 1,000 estate plans, so there's no need to cry. Let's trade in the Chevy for a Lexus Model I. Let's trade in the Chevy for a Lexus Model I. So bye-bye life expectancy sigh. I am lucky the Secure Act lets teapot trust apply. This is the day the life expectancy rule died. I can't wait till Natalie's book is revised.
Now let me introduce you to Alan Gassman. He'll be followed in approximately 1 hour by Carl Mill, and you might just want to leave now and come back in an hour. That's probably the best strategy. Thank you. Okay, welcome to Saturday, 11 a.m. And this topic is one near and dear to my heart, and that is estate planning techniques that our law firm has helped to invent or popularize. And sure, a lot of these things are other people's ideas that we, I think, improved or made them a little bit better or easier to understand. And again, I'm really, really interested to hear what Carl Mill is going to say about what I need to know about cyber currency and charitable deductibility, because a lot of people have a particular kind of cyber currency and they want to convert to another one, and that will trigger a lot of income tax. But if you put that under a charitable remainder trust, you can defer that tax for a long, long time, and only a very small amount ends up going to charity in 20 years. So Carl's going to enlighten us in that area. For those of you who are new to the program, it does not qualify for continuing education credit. Not that we didn't try, but the authorities just said the program was not good enough for the credit. Ask again some other time. And quite honestly, I prefer that most of the attendees are on this broadcast because you want to be, not to get the educational credit. How do you ask a question? Well, just if you yell really loud, I'll hear it, even if you're muted. But the other way to do it is click on the question, a little triangle, and then that question panel will open, and then you can click on it. And I see a lot of you already had. Good morning, Carilla. Good morning, Robert. I'm glad. Oh, David, he said, this is painful. Well, maybe that's what you like. All right, so that's how you ask a question. I wanted to mention maybe one of you will buy the book, Planning for Ownership and Inheritance of Pension and IRA Accounts and Benefits in Trust or Otherwise. We updated this for the Secure Act, and now we're about to update it again because all the numbers have recently changed if you didn't hear. But, this is on our Amazon library. So some upcoming events. Next week, estate tax planning questions and answers. So please send me some questions so I don't have to make all of them up. And then the following week, we're going to talk about qualified personal residence trusts and S corporation planning. That's two separate topics, but we'll talk about them on the same day, and hopefully no one gets hurt. We do have a YouTube channel, and you can go to our YouTube channel free of charge. And here I'll show you the YouTube channel. So when you go to the YouTube channel, at the top is a recent webinar that you can click on. And this was Mathematics of Estate Planning with Jerry Hesh. And then the next row down are the Saturday series. So you can go back and watch your favorite Saturday series. And then the next row below that is our Charitable series. And we'll be adding Carl's presentation to the Charitable series. And then below that, we have an asset protection row, and then a business row where I've talked about business strategies, and then physician protection and medical type row, and then employee management for those employees who are still left and haven't left me, then advising business owners, then the PPP section, which was very popular for a while, and etc. So that is the YouTube channel. You're welcome to go there at no charge. And the more you click, the more our YouTube revenues are. Come see me in Tallahassee, May 19th, May 20. Sign up for the Florida State University FICPA Accounting Conference. Would love to see you there. So now let's talk about the Joint Exempt Step-Up Trust. And here's some articles on it. I'll be glad to send you one of these articles if you just ask. So most of you know that when you die, you have a $12,060,000 estate tax exemption. And most of you have separate trusts, or if you're an advisor, you typically have your clients advised to have a separate trust, one for the first dying spouse and one for the surviving spouse. And on the first death, up to $12,060,000 can pass into a family or bypass trust, whatever you want to call it, which can benefit the surviving spouse without being subject to estate tax when the surviving spouse dies, or generation skipping tax if it then goes to children and grandchildren, or that next spouse who's just waiting to pounce upon the surviving spouse, or creditors of the surviving spouse. So it can be very important on the first death to get as much as you can into an irrevocable trust to avoid all those terrible things. So in the non-community property states, which is most states other than Texas and California and the few other community property states, in a non-community property state, the traditional way of doing this planning is to have two separate revocable trusts. One for the first dying spouse, who may be sad because they have to die first, and then one for the surviving spouse, who may be happy if most of the assets were here in the first dying spouse's trust. So if you have $24 million, you're fine if you have 12 million in one trust, 12 million in the other trust. The first spouse dies, the 12 million's nicely locked up, and you've got the credit shelter trust. You're doing all you can for the estate tax avoidance. That's nice. But what if this couple only has 15 million? And I don't mean to belittle you if you only have 15 million. You probably already belittling yourself enough. But if you only have 15 million and I don't know who's going to die first, what am I going to do? I'm going to put 7.5 million here, 7.5 million there, and say, hey, by the way, if you ever get a bad diagnosis, please remember to call me. I'll give you a little sympathy and we'll move those assets into your trust and protect those assets from that next spouse and from estate tax, etc. So, you know, that's a problem that we and many clients have. So another problem that many clients have is that they want creditor protection. So it's popular in states like Florida to try to do a joint revocable trust. And then that joint revocable trust may qualify as a tenancy by the entireties trust. And therefore, if somebody sues one spouse, they can't reach the assets because Florida, Delaware, Wyoming, and a few other jurisdictions have tenancy by the entireties. And I'll mention here, because a lot of you are in Florida, a lot of you are tax lawyers and CPAs in Florida, that the bankruptcy courts don't like joint trusts that pretend to be tenancy by the entireties trusts when they really aren't. So if you want tenancy by the entireties protection, it might be better to have the two spouses simply own an LLC as tenants by the entireties, which then passes to a revocable trust on the second death. A little bit off topic here, but I don't want anyone who's watching this presentation to assume that they should only have this separate trust for each spouse, when maybe for creditor protection purposes, they should have this. And then if they own the assets as tenants by the entireties and spouse one dies, then after the funeral, spouse two can disclaim up to half of the assets that would have come by joint survivorship and go into the first dying spouse's revocable trust. And that was pretty much our playing field. Now, if you were in California or Texas or another community property state, then you would do a joint trust, and on the first death, get a step up of all income tax basis for all the joint assets, because that's what community property does. But the downside of that, of community property, is if one spouse gets sued, the creditors can take everything. So clients and advisors in community property states were pretty much stuck with either a joint trust, which goes half into a credit shelter trust on the first death with a full step up, transmuting out of community property and having separate trusts, pretending that they're in Florida where the weather's better in the winter. So those were the choices. And there were
Oh, and by the way, here's an article that I wrote with Jonathan Blotmacher on the stepped up basis conversation. So most of us are concerned with getting that 12 million in the trust on the first death. But if you could step up all the assets of that married couple, if you had that $15 million married couple with 7 million 5 in each name and one dies, you get a step up in income tax basis to avoid capital gains tax on only the assets owned by that first dying spouse. So that was another issue. Well, Jonathan changed the playing field for all of us in the 1990s by not only inventing disco, but also inventing what he calls the Alaska Community Property Trust. And he said, hey, Mr. and Mrs. Spouse 1 and Spouse 2, you could live in Florida, but put your $15 million worth of assets into an Alaska Community Property Trust. And if one of you dies, I get you a step up in income tax basis on the whole 15 million. But you're also in a community property regime, which means that you only get half into a credit shelter trust, and that creditors of either spouse can get into the Alaska Community Property Trust. So the Alaska Community Property Trust is a very popular way for wealthy people to get a full step up in basis on the first death. But it's expensive because you have to draft an Alaska trust, and then you have to have an Alaska trust company as trustee. Well, people with $300 million, that's not expensive at all. People with $300,000, that can be pretty expensive. So I was looking for a joint trust that would allow a full step up on the first death and would allow full funding of a credit shelter trust on the first death. So now my client with $15 million in assets, they would put the assets into a joint trust. If one dies, they would get a full step up, just like they were in a community property state. And then if one dies with a $12 million exemption, the first 12 would go into the credit shelter trust, and the remaining 3 would not go into the credit shelter trust, so they would use their full exemption. And I wanted to call that a joint exempt step-up trust. Actually, we didn't know what to call it. Christy Denicolo and I probably spent an hour and a half going through potential names until we came up with the JEST Trust, Joint Exempt Step-Up Trust. And what we really like about the name is that it's also a real word, and I like to jest around anyway. So that's what we came up with. Now, long story short, the JEST Trust should work to get you a step up in basis on the first death, but it might not. The IRS may not agree with our rationale. And I'll talk to you a little bit about the rationale. The IRS may not agree with the Alaska Community Property Trust rationale, but I will freely admit that the Alaska Community Property Trust has a better chance of a full step up on the first death. Now, how did we, and then here's other charts that pretty much show you the same things that I talked about. By the way, a lot of advisors say that you don't have to fund a credit shelter trust on the first death. Just leave it all to the surviving spouse and then get what's called a portability allowance, which means if I die and everything goes to Marcia, Marcia now has an exemption of her 12,060,000 plus my 12,060,000, and she can get up to $22 million worth of assets. So that's good, but if she remarries and her new husband dies before her, then she loses that portability allowance under certain circumstances, and her portability allowance doesn't grow with inflation. And if she wants to do generation skipping, more assets to the children that don't get taxed at the children's level, that 12 million portability allowance doesn't work for that. So if you're a layman, you have no idea what I just said, but you know it's bad. And we prefer the credit shelter trust over the portability allowance in most situations. And there's a mathematical example here. And I can refer you to, I think if you go to YouTube and Google Gassman jest, we go over this on another thing. So in 2012, I was fortunate enough to write a couple of articles with one of my heroes and one of the smartest people I've ever dealt with, Howard Zaritsky. And Howard Zaritsky and I were talking about what to do with the exemption now being $5 million, because it had come up from low to 5 million, and everybody was just shocked. So now there was no more need for estate tax planning for many, many people. So asked me to write an article with him. And when you write an article with Howard Zaritsky, you just can't believe how much you learn. You send him a sample paragraph, and he emails back and says, well, there was this letter ruling in this case, and here's where I just brilliant, brilliant. But we talked about some private letter rulings where people had tried to use a joint trust to get a step up in basis on the first death and to fund a credit shelter trust. And the IRS said, this won't work. And so what these rulings said was, first dying spouse has the power to appoint assets to creditors of her estate. And under Internal Revenue Code Section 2041, that means that those assets are owned by the first dying spouse. If they're owned by the first dying spouse is not enough to get you the step up in basis, because of another a subsection of that provision, which says that if you give something to somebody and then you inherit it, it doesn't get a step up. If you give something to somebody and then you inherit it within a year, it does not get a step up. So my idea, which Howard did not like at first, moral of that story is when you have a good idea and somebody doesn't like it, just keep asking until you find someone who likes the idea and then reconsider. So Howard didn't like the idea, but I liked it. And it was, if Alan dies, he has a power of appointment over half of that, over Marcia's half of the joint trust. That passes into a trust, not for Marcia, but into a trust for Alan and Marcia's children. And trust protectors, who happen to be our CPA and our best friend, could add Marcia as a beneficiary later. So Alan dies, they have the funeral, it's really sad. Marcia sells the assets, pays no capital gains tax, now she's happy. She waits to see if the IRS audits the sale of the assets. The IRS doesn't audit the sale. She goes to the trust protectors and say, adds me as a beneficiary. So if you do that, then even Howard thinks that you are safe here. And he even said that, and I tape recorded it and played it back, and it was the happiest day of my life up until then. So here is the jest. No, I'm not jesting. Spouse 1 has a share of the trust. Spouse 2 has a share of the trust. When spouse 1 dies, spouse 1's share of the trust goes into the credit shelter trust and gets a step up, just like any trust. But when spouse 1 dies, she has the right to appoint the assets of spouse 2's trust to creditors of spouse 1's estate. She doesn't exercise that power, and as a result, those assets go into credit shelter trust B, and spouse 2 is not a beneficiary of credit shelter trust B until she's added by the trust protectors. So if this is $15 million in a just trust, the first the $7.5 million are going into credit shelter trust A, 7.5 are going into credit shelter trust B. You've got a full credit shelter trust funding, and that is confirmed by the private letter rulings and a technical advice memorandum. And then, in my opinion, you have the full basis step up. Now, the private letter ruling said no basis step up, but that was when spouse 2 was a beneficiary initially. Now, I still think the private letter ruling's wrong, because if I die and I have a power of appointment over Marcia's assets and I don't exercise it and it goes into that credit shelter trust, it did not go back to Marcia within a year of my death. It went to a credit shelter trust for Marcia. And the statute and the regulations say to the person who gave it to you, not to a trust that they may never touch. The other thing that the Just Trust says is that Marcia first receives benefits under Trust A, and not until her other assets run out and Trust A runs out is she to receive anything from Trust B. So even if she's a beneficiary of Trust B from the beginning, I think you get your step up. Now, those of you who are still awake have another question. Why would Marcia give Alan the ability to appoint assets to creditors of his estate? He may, on his deathbed, meet some very attractive nurse and sign a promissory note to her and then appoint those assets to creditors of her estate. And this brings me to my favorite provision under the regulations under Section 2041. And if you've never read the regulations under Internal Revenue Code Section 2041, you should just like turn off this show right now and read them. Because they say that I could have a power to appoint assets to creditors of my estate that is only exercisable with the permission of an uninvolved person. They call that a non-adverse person, a non-adverse person. So if the trust says Alan can appoint the assets of Marcia's side of the trust to Alan's creditors, but only with the permission of our next door neighbors to the left and our next door neighbors to the right. Well, guess what? Those next door neighbors to the left and right are not going to give permission. They don't even like me, let alone my nurse. So there's really no risk of a problem. And by the way, as long as we're at it, what if I make my father-in-law a beneficiary of the Just Trust and give him the power to appoint to creditors of his estate with permission of my next door neighbor? And then my father-in-law dies. Do Marcia and I get a step up of all the assets in the Just Trust? And if it's an irrevocable Just Trust, that's possible. So this is the chart that explains the Just Trust. It is harder to draft than the other trusts I've mentioned, and it is harder to administer than the other trusts I mentioned. The other thing I'll say about the Just Trust is I am at higher risk of being sued than Marcia. I'm a tax lawyer, and I might get sued. Marcia is less likely to be sued. So the Just Trust can provide that it's 5% mine and 95% Marcia. So if I get sued, maybe 5% of the assets are subject to problems. But if Marcia dies first, she still has that power of appointment over the 95%. So the 95% would go to Credit Shelter Trust A for me, and the 5% would go to Credit Shelter Trust B for me. So we have had clients, with the advice of California lawyers, transmute out of community property treatment, and in Texas also, transmute out of community property treatment, then eat some barbecue, and then set up a Just Trust instead of a conventional community property trust. So the client who's the neurosurgeon only owns 5% of the trust. If he gets sued, he doesn't lose it. The client who's the office manager, who's in charge anyway, owns 95%. So everything is safe and sound. It's not without risk, but we think it's a better arrangement. And we have been quite candidly flattered when people have said, yeah, I just put $200 million of my client's assets into a Just Trust. That feels pretty good. So Now, some clients get older and infirm, as I'm getting older and infirmer myself. So you could make an irrevocable just trust that's only revocable when good friends allow it to be revocable. And then you could do one for the son and one for the daughter, and they don't get along. Put the business in the son's irrevocable trust, the daughter, the real estate in the daughter's irrevocable trust, have both parents as beneficiaries of both trusts, give each parent power of appointment, exercisable in favor of creditors, and you can go ahead and get your estate protected. Now, another thing that I may have invented, but I'm sure I didn't, but I didn't find it anywhere else, was what I called the marital asset preservation system, which stands for MAPS because it gives you a sense of direction, but it never became famous. Howard Zaritsky never mentioned it at the Heckerling Institute. I'm very sad. But what this does is it's simply an agreement. If your clients are not going to put all their assets in a just trust, and you can't put everything in a just trust. You've got certain assets that just don't go there, like an IRA, a pension, things like that. Can you have an agreement? And the agreement says, if one of us dies, the survivor will make darn sure that all of our assets are in trusts, or a certain percentage of value of all of our assets are in trust. The surviving spouse is required to establish an asset protection trust. The asset protection trust can be drafted in advance. Oops, I'm sorry. Turn off that. Okay. Sorry about that. So the asset preservation system is something to think about. One client dies, the survivor is required to do the asset protection trust. We're always worried that a client will wait until it's too late, they're being sued, and then they finally get around to preparing the asset protection trust and funding it. There's a good business reason to fund that asset protection trust if it's required by a written agreement. Okay, so that is the marital asset preservation agreement. Let me see here. I lost my question box. So let me see if I can open it and see if I have any questions. And I do have some questions. Are there any questions on the on this? And let me see. If one is administering a non-revocable trust with two beneficiaries, the trust owns stocks and municipal bonds. I'm going to answer that next week. Okay, because I don't know the answer this week. Here's the next thing that we've used successfully on a few occasions and has been popular with other lawyers. As you know, if you've watched a number of our webinars and haven't become comatose, one of the very best strategies is the Biden two-step, which is the installment sale to a trust. So now the client has a $30 million promissory note owed to her. And in this example, age 73, December 2021, this note, a $30 million note, could bear interest at 1.89%. And on death, the note will be subject to estate tax. The note will have to be valued. It could probably be discounted, but it will be subject to estate tax. But here is her alternative. She could do a 12-year self-canceling installment note, and then the payments would have to be about $70,000 a year per million. So on 30 million, she would receive payments of $210,000 a year. And then on her death, this would never be subject to federal estate tax. The note goes away on death. You just have to hope that she's going to die within 12 years if you set the interest rate at 6.587%. If you want a longer note, then you have to have a higher interest rate. And only Jerry Hesh understands what the interest rate will be because it's so darn complicated. And the software companies only have you do the note up to the life expectancy of the person. But you can go longer according to Jerry, and I believe Jerry. Now, the other alternative is you pay the person under a private annuity, and if you did annual payments of $93,000 a year per million, then you could do a private annuity and it cancels on death. Well, believe it or not, I know this is going to surprise you. The IRS does not like self-canceling installment notes. And they say that the Treasury regulation, which allows you to use standard life expectancy tables for a private annuity sale, does not apply for a self-canceling installment note sale unless the person is of average health. So with a private annuity sale, where an age 72 person in December 2021 could sell $1 million worth of assets for $93,000 a year, the regulations say you can do this as long as you have better than a 50% chance of living at least a year. And if you have less than a 50% chance of living at least a year, you can't do this unless you actually live 18 months after you put it in place. Well, so the client comes to us, and this unfortunately does happen, and says, well, I have metastasized cancer of the lung. It's spread. I've got a 3 to 4 year life expectancy. I'm going to fight it. I might go 6, 7 years. Shouldn't die in the next year. I've got a $30 million note owed to me. What should I do? And the answer, until the IRS made a hard assault on self-canceling installment notes, was usually, let's just convert that $30 million note to a SKIN, a self-canceling installment note, change the payments from $12,000 a year per million to $70,000 a year per million. And if you die as scheduled, we've avoided the estate tax. People aren't as sad as they would have been. The IRS in the Davidson's case said, no way, Jose. Mr. Davidson, who owned the Detroit Pistons, he had owned the Tampa Bay Lightning, but they weren't winning, so he sold them. Now they're winning. But he kept the Detroit Pistons, and he sold a big part of the Pistons for self-canceling installment notes when he was apparently in bad health. And the IRS said that that was a gift. Now, you can't just do a private annuity sale from an irrevocable trust like a note sale because of something called the probability of exhaustion test. So you have 3 regulations you have to read immediately after this program. One, section 20, the regulations under section 2041, powers of appointment. Second, the regulations as to private annuity sales and life expectancy tables. And then third, the probability of exhaustion test, which says that if you're going to sell assets to a trust, that trust has to be really well capitalized, really well capitalized. And you have to hire Jerry Hesh to tell you how well capitalized it has to be. But for a 72-year-old, a $30 million sale, you need about $30 million of net value in the trust above and beyond the liability considered as owed. So I wanted to find a way for a client to convert a note or enter into a self-canceling installment note without the risk of gift tax. Because when I explained this to clients who were ill, I would say, I'd rather do a SKIN than an annuity. But please understand that you could owe gift tax during your lifetime. If you get better and the IRS finds out we did this, you could owe a gift tax. And the clients would say, don't want to pay a gift tax. Don't mind if my children take the risk. And by the way, in many cases, when you do this, there's no Form 706 estate tax return to be filed. So the chances of scrutiny are low, but clients still don't want to risk the gift tax return. So we came up with the idea of the SCRAT. And it's a self-canceling note that is contributed to a grantor retained annuity trust. So, and it was not an original idea. It was based on something that I had seen in one of Stacy Eastland's outlines on using grantor retained annuity trusts and self-canceling installment notes. But Stacy didn't, to my knowledge, Stacy never really showed it this way. So in my example, a client has $2 million worth of assets, and he puts the $2 million worth of assets into an LLC, and he takes back $1.5 million promissory note. So on day one, the client owns the LLC, and the client is owed a note from the LLC. So the LLC is only worth $500,000 if we can use the standard tables. Or if the IRS comes in and says that note's only worth $100,000 because the probability is he's going to die before he ever gets the principal payment. So the LLC is worth $500,000 if I'm right and $1.8 million if I'm wrong. And I want to get it out of my client's estate. So he contributes the LLC to a grantor retained annuity trust that pays him $130,000 a year for 4 years, which is equal to $500,000, and that is out of his estate. If he dies, the trust only owes him a couple of payments. His estate is under the exemption based upon his situation. Now, if the IRS comes in and says, "Ooh, we see you did this. We think you made $1,300,000 gift." Well, because of the mechanics of a grantor retained annuity trust, when you get caught in that situation, you don't pay a gift tax. The grantor retained annuity trust simply makes greater payments out, and there's no gift. So that is the SCRAT. Now, I will mention that last month, there was a new IRS shot over the bow. I should have brought my little toy gun. Shot over the bow, where the IRS, a man set up a GRAT, and he was really, really, really aggressive and arguably irresponsible in valuing the assets that he put into the GRAT, and the payments he took back from the GRAT were very small compared to what the IRS said they should have been. So the IRS said, your GRAT is disqualified because you really didn't intend to follow the rules. And under the Atkinson case, which is a charitable remainder trust case, if you don't intend to follow the rules, the trust is disqualified. So you have to be careful with GRATs, and you have to be careful with SCRATs, and you don't have to like cats, but that is the SCRAT. And then I've got a step-by-step chart. I've got a little thank you to Stacy Eastland, who's a wonderful speaker and a wonderful writer, and then a step-by-step example of how the SCRAT can work. And I thank a lot of lawyers who have commented on the SCRAT and helped us think through the SCRAT. And then I have a chart here on comparing the self-canceling installment note to the private annuity to the GRAT, and then you can consider the SCRAT as well as that. So the next technique I want to talk about is the teapot trust. And this would be normal tea, not that other kind of funny tea, nothing to do with psilocybin. But the system of the taxation of IRAs and pension plans passing into trusts has always fascinated me because it's 90% logical and 10% just crazy. And in 2000, so I wrote a book on this. Denicolo, when he went to the LLM program at University of Miami, maybe 15 years ago, I told him I wanted to write a book on this subject. So when he took this course, we started writing this book, and we finally finished the book, I think about 10 years ago. And then we had to rewrite it for the 2017 Secure Act. It used to be that an IRA could be payable to a trust when you died, and then the money would come out of the IRA over the life expectancy of the oldest beneficiary of that trust. So if you had all the right language, and I left $1 million of IRA into a trust for my daughter, it wouldn't have to be withdrawn right away. It would just come out over her life expectancy. If she's 50, maybe it would come out 8% the first year, 8.5% the second year, so on. And that was called an accumulation trust. And they changed that. And now, unless it's your spouse or a disabled individual, it's coming out within 10 years. So a client, first of all, a client who has a spouse, who trusts the spouse, will typically leave the IRA to the spouse. The spouse will roll it into his own IRA, not have to take a distribution until after age 72. It was 70 and a half, but they changed it to 72. But then when the spouse dies, now it goes, I don't like it to go outright to the children because they lose it in all different ways. They lose it. They lose it in bad investments. They lose it in too much spending. They lose it in a divorce. They lose it in a lawsuit. It gets subject to estate tax when they die. I want it to go into an accumulation trust, but it's going to come out within 10 years. Now, when it came out over the life expectancy, it didn't bother me as much, but over 10 years, there is an issue. And the issue is if you want to, and by the way, a lot of the rules are summarized here. The issue is if I leave 10 million of assets and 3 million is in IRA, 7 million not, and I have 3 children, and one is in a really high tax bracket and one is in a low tax bracket, one's in the middle and ate the porridge. So of the IRA to the lower tax bracket child and more of the other stuff to the higher tax bracket child so that they pay less in income taxes? And the answer is yes. You would definitely, if you thought this through and you had one child in the 15% bracket and one child with California tax in the almost 50% bracket, you would just leave the IRA to the low bracket taxpayer. But then how much and how do you offset and how do you figure out what you're going to do with that? And how do you know how soon they're going to pull the money out? Are they going to wait till the 10th year or should they do it incrementally based upon tax brackets? And what if the one in the high bracket turns out to be in a low tax bracket and has a lot of losses? And how are you going to do this? Well, the answer is the Teapot Trust. And the Teapot Trust doesn't, I think it stands for something. I don't remember what it stands for. It stands for something that spells out teapot, of course. And what I did was I said, I know that I need to get the IRA into a separate trust so that the trustee of that trust, just like a teapot, can pour the money into the right trusts at the right time. And you have about 11 years to do that because you have until the December 31st of the 10th calendar year following the client's date of death. It's not 10 years, it's 10 years plus however much time was left in that last calendar year before they died. So it's easiest if the client could die on December 31st, then it would be 10 years. You could recommend that, but they may not follow your advice. So, but the complexity of that is if I leave 7 million equally to the children and then 3 million in this IRA trust, then how do I equalize? And the answer is you leave 3 million of the IRA in the Teapot Trust, and then another couple million in an equalization trust, and then split up the 5. So now the skillful CPA, the skillful tax lawyer, the skillful oldest child or the most responsible child, which is commonly the oldest child, and every year have a meeting and say, how's everything going with the first 5? And what should we pour out or should we wait? So you may wait until year 11 and pour it out to the lower bracket children and then pour out the other to the high bracket child so they get the right amount after taxes. So you have the Teapot Trust and you have the equalization trust. So we've got other alternatives to the Teapot Trust, but people have been drafting documents to incorporate the Teapot Trust. And if you just look at an example that we gave here, where the IRA was only 900,000 and the tax bracket difference was only 30%, the tax savings after a period of time would be still hundreds of thousands of dollars. And the other thing I like about the Teapot Trust is it forces the children to get together once a year with the advisors. So they could actually compare how they're doing from an investment standpoint, how they're doing from a spending standpoint. And maybe that most responsible child meeting with the advisors and the other children will rub off a little bit. And then the other thing I like about it is waiting 11 years. Because, oh, I got my inheritance. I think I'll invest in a boat. I think I'll invest in sports cars. I think I'm out of money and it's year 11, and boy, am I glad that there's still money left in the Teapot Trust. So that's another thing I like about the Teapot Trust. Now, one other thing I like about the Teapot Trust is that my friend Kristen Sweeney, who had a new baby and has co-written things with me, liked the Teapot Trust idea so much that we wrote a song, and we can play it.
Are you ready, Eliza? Here comes our special song. Grandpa needs a teapot for his trust. Talk to his attorney, 'cause Grandma said he must. The lawyer got him fixed up right as rain. Now his IRA payments won't go down the drain. The teapot is a special kind of trust, it's true. Here's an example of what it can do. Save you time and money, and don't forget to mention it's the perfect plan for Grandpa and his pension. Do you know what a pension is, Eliza? We could talk for hours about its many perks, but now you might be wondering just how the teapot works. Well, picture 3 cups filled with liquids alike, but rocks in 1 cup means the liquid takes a hike. So although the cup looks full, it's really not. There is an important lesson to be taught. The teapot can be used to avoid this drought, so the IRS won't pour you out. Yay! Good job, you! Yay!
Until I had a grandchild, I didn't really appreciate what a great job Kristen did keeping that baby, Elijah. I'm happy. So way to go, Kristen. Thanks very much. Now, another idea that we've been using that I haven't seen before is I simply have the spouses sign an agreement that says, when I die, I will leave you my IRA, and you will put it into a rollover IRA, and you will invest it with XYZ Investment Company, and you will report to our children, and you will not take out more than you need, and you will keep our children as beneficiaries. And that is simply a written agreement with the children as third-party beneficiaries. Now, does that disqualify the IRA rollover when the first client dies? What are the chances? Does it disqualify it? I don't know that it does. What are the chances of that becoming a problem from an IRS standpoint? Low. What are the chances otherwise of that IRA going into enemy hands later on? I don't know. But that spousal accumulation agreement is something that you can consider for that surviving spouse, as opposed to having to do an accumulation trust where it has to come out much, much sooner. The last thing I'm going to mention, and then we're going to go to Carl Mills, and I'm finishing a little bit early at everybody's request, is the crest. And what I want you to remember with respect to the crest is that a lot of times, usually, it's better to own real estate in an LLC owned as a partnership than an LLC owned as an S corporation. For one thing, the step up in basis is cleaner. For another thing, if somebody buys into a partnership, they can get a new basis for that portion under what we call Code Section 754. You can't get that with an S corporation. You could have foreigners own ownership in a partnership. You can't do that with an S corporation. When a partner dies, you get new depreciation step up. With a 754 election, you don't get that with an S corp. But the S corp has one huge advantage, and that is if the company becomes insolvent and there is income from the discharge of indebtedness, if the S corp is insolvent, the discharge does not come through. With a partnership, if I invest in a real estate partnership, the partnership becomes insolvent, then at the time of that insolvency, the debt is forgiven by the bank because I'm not a guarantor, yet I am solvent. I end up paying income tax, and I sure wish that had been in an S corporation. So when we thought the financial world was going to come to a huge recession in February and March of 2020 with the COVID virus, what we did was we went to clients who had their real estate in partnerships, and we said, you may want to make an S election, but you may not want to make an S election. If things go well, you'll wish you were a partnership, but if things don't go well, you'll wish you were an S corp. But one thing you have when you have an LLC taxed as a partnership or disregarded is the ability to look back 75 days. So what we told clients who had a lot of leverage on their property is, let's look. And if the debt you owe on the property does not exceed the basis of the property, then you can convert from partnership to S corporation and get that done. But if you're going to borrow more money on the property or take more depreciation on the property, then when the debt exceeds the basis, it'll be too late for you to make that election. So we want to amend and restate your operating agreement so that it will allow you to be an S corporation when you elect. And then we want you to watch that carefully and make that S election at the right time. So we had a few of these ready to go, and thankfully we didn't have to use them. I was thinking there was a good chance that 2007 through 2009 was going to happen again. Fortunately, it didn't. But that is the crest, and that's the convertible real estate S corporation technique, and we had a lot of fun with it. The final item, the Biden two-step. I think everybody on here knows that we did not invent the Biden two-step. We simply popularized or helped to popularize putting seed capital gift into an irrevocable trust and then selling a discounted LLC interest for a long-term note to significantly reduce federal estate tax. And so this couple would put $20 million of appreciating assets into an LLC and then set up irrevocable trusts that would receive $700,000 each in seed capital gifts. And then they would sell not 99%, 49.5% each of these LLC interests for $7 million notes at 1.35% interest. This particular month that we did this, now it's more like 1.9% interest. And then when these assets double in value, which happens on average every 10 years by my experience, the assets are worth 40 million, but the estate tax inclusion is only about 7 million each. So that's the Biden two-step. We did not invent that by any means. We simply helped to make it more fun and popular. So speaking of fun and popular, Kelsey, how do I turn this over now to Carl so I can learn and listen for a change? Yeah. So Carl, before we get started, I have been so pleased to work with you because you have phenomenal knowledge in this charitable giving area and in the tax area. And I think a near photographic memory, because you have to have a photographic memory in this area or do a lot of research because the rules are so illogical in many ways.
Yes.
And you've got the passion, and you have the passion for it. So
Yeah.
tell me what did you do undergraduate? Where'd you go to law school, and how did you end up
Yeah.
being such a maven at this?
I mean, first of all, the feeling's mutual. I always appreciate it. I learned a ton over the last hour, so I really appreciated that. You know, philosophy major, was a teacher for a bit, went to law school, Columbia, and made my way into a big firm doing high net worth estate planning. So I have a vague memory of skins and grat, so I didn't know about the scrat. It went up to Adler and Colvin, which is a boutique firm here in San Francisco that serves nonprofits around the country, does some charitable gift planning. And then became a partner there last year, and then around June of last year launched my own firm that's also another boutique firm that focuses on nonprofits, nonprofit law and charitable giving exclusively. So it's probably about 40% public charities, about 40% foundations, probably, and then 10 to 20% kind of working on individuals with some of the stuff we'll talk about today.
Beautiful. Well, congratulations on having your own firm and on being who you are, because there aren't many people with the mental firepower and the ability to be in a relatively small area of tax law that you really have to do a lot of to be knowledgeable in.
So appreciate that, man. Very, very kind of you.
Now, before you get started, and I know this was going to be 30 minutes and it's going to end up, I hope, being at least 45 minutes. We have a lot of viewers who are not tax lawyers and are not CPAs. And like me, they may know what cryptocurrency is, but not be real sure. So can you start 5 minutes for the layman?
Yeah.
Because all of us tax lawyers really need it. Can you just start really, really simplistic? What is it and how is it taxed? So just to make sure we leave no one behind.
Yeah, no, and I think the first few slides I have lined up really are intended to get at that. So maybe we'll start there. Are you seeing the slides okay? Is that all showing?
Yep, look great. Yep.
So I mean, a lot of what's been an interesting part of my practice, sort of being in San Francisco, is just the sheer quantity of questions I get about cryptocurrency. Whether it's people giving them, whether it's people wanting to set up nonprofits revolving around cryptocurrency, all kinds of stuff. And at first, like maybe many people in the audience, you kind of maybe roll my eyes a little bit, or like, what is this? So I really have to learn what these things are. But you have to follow the clients where the money is, and sometimes the money is in these sort of random assets, right? So let's start with sort of cryptocurrency. We have a technical definition of digital currency in which transactions are verified and records maintained by a decentralized system using cryptography rather than a centralized authority. But to break it apart in more practical terms, as we understand it, cryptocurrency is something that lives on the blockchain, which is a bunch of servers all around the world talking to each other and verifying various records and solving math formulas to keep verifying the records. And you could think of it as sort of a global decentralized database. And one of the things on that database is it says there's a database, an entry for a particular coin, and it says you own that coin. So really, when you're buying a cryptocurrency, you're buying the right to get added to that blockchain and have it right. Carl Mill owns this Bitcoin. Of course, I don't own any Bitcoin, but I certainly couldn't afford it at this point. But you get the idea. And we'll talk about NFTs in a second too. But one thing that is useful is to remember that cryptocurrency is a very broad term. We're going to use it pretty broadly today. There was one lawyer I talked to who gave it a really good analogy, because I had sort of said, we'll just assume this sort of nonprofit is willing to accept cryptocurrency. And he said, well, that's like saying this nonprofit is willing to sign an agreement as long as it's a PDF. Like it's a cryptocurrency is a format. It doesn't define what it is. So I've listed some of the common ones, the ones that are treated most like currency. But there's other kinds of things that we call cryptocurrency. We'll talk about DeFi tokens a bit. We'll talk about how there are kinds of cryptocurrency that are targeted to a particular company, really sort of disguised initial public offerings done as initial token offerings, where the thing you're buying is a coin that operates a lot like buying a share of the stock in the company. I've had clients doing energy, sort of sustainability work that launched a coin that was tied to the European electrical grid, and so when you're investing in this token, you're doing something to bolster the electrical grid. I don't understand, but it could be tied to a particular commodity. So it's all kinds of things, really. When I think some of the logos you see are kind of the most common ones that your clients may be running into and have and want to give or want a estate plan with. But they can take all different kinds of forms. So the first lesson is always kind of understand what it is you're getting into. And I guess while we're talking definitions, maybe it's the other thing I'm going to try to talk about are non-fungible tokens. And this is where you will almost certainly roll your eyes, Deepak, as I have, but we all got to get on board. Non-fungible tokens are really you can think of them as cousins to cryptocurrency. I'm going to lift them all together. These are also on the blockchain with unique identification codes and metadata that distinguish them from each other. I've snapshotted some common NFTs, and these NFTs are somehow worth lots of money. And but at the end of the day, what are they? Well, it's an entry in a database that says you own Green Ape 25 on the top left corner. That's yours. You own it. You could sell it to someone else. You could buy it. So these are kind of what we're talking about when we talk about NFTs. And I'll talk why when it comes to charitable giving, NFTs have kind of become particularly popular. Let's keep going. And so you ask sort of for tax purposes what they are. And I think fundamentally the important thing to remember is that the one thing cryptocurrency isn't is currency. It is not currency. You go out to the store and you use $100 to buy goods and services, you do not pay any tax. If you go to the store and use appreciated Bitcoin to buy goods and services, you are actually incurring a capital gains tax because that is not currency. Instead, crypto is a capital asset. It's property. And so, and I suppose conversely, if you use the depreciated cryptocurrency, you could also incur a loss. But it's always been sort of strange to me how it's sort of being offered as you can go to the store and buy these things when I don't know that people are recognizing or certainly not reporting all the sort of taxable gain that's being incurred along the way. So that's always seemed a trap to being wary. And the other sort of kind of key point to remember, since we're talking capital assets and we're talking about charitable giving, really important to distinguish between short-term and long-term capital gain. I'm sure everyone's kind of familiar with those concepts, but when we get into the charitable giving rules, which as Alan alluded to, are painfully complicated, short-term and long-term can make a big difference. And so whether you've held this crypto for a year, this NFT for a year, this token for a year, it can significantly impact your tax planning. This chart, we're not going to go through this whole chart. This chart is my unified theory of charitable giving. I want to distill a couple key points. When we're talking about charitable giving, often the public focuses on the charitable contribution deduction. And we're going to talk about the contribution deduction. But it's really important to remember that that's not the only thing that drives charitable giving from a tax perspective. It's just one benefit of one. So obviously, gift tax-free transfer, that's well understood. You give to a charity and also give to a C4, C5, or C6. That is a gift tax-free transfer. So it removes it from your estate. But of course, we have to think about things like 2036 and not going to get pulled back in. I want to know if that drives a ton of charitable giving. It can in some circumstances, certainly. I think the thing that drives the most charitable giving of all is actually the second box, avoiding taxes on appreciated assets. People don't necessarily give to get a deduction. They give to not have income, have capital gain that they would need a deduction to offset. You don't need a deduction if you don't have income in the first place. So and this is absolutely true of cryptocurrency. What do we know about cryptocurrency? There are lots of people with a lot of assets based on the fact that they bought crypto at a very low number and now have it at a very high number. And they may want to go from having crypto to having a yacht or having a house or having a business. And so they want to sell. And so that when you have something that you want to sell and it's going to incur a lot of gain, that's very commonly what brings people to charitable giving is I'm about to have this realization event. I'm going to give this to a charity that doesn't pay taxes, let it have the realization event, and then I can do all the things I want to do, all the good things I want to do in my charity, or maybe a C4, I could do there. And if I want to get smart about tax planning, I talk to someone like Alan about CRTs and CLTs and how I could sort of not only accomplish a charitable gift, but also sort of either shift assets to the next generation, free of estate tax, or set up a tax favored income stream for the rest of my life. So those, those are all sort of things on top of you have an appreciated asset. And you can think of all this crypto and NFT stuff as a bunch of appreciated assets. The next thing is tax exemption. That's sort of ongoing income from the asset. Won't bear tax, so that can be obviously helpful. Then we get to the charitable contribution deduction, and as you'll see, I have sort of two sub boxes. One for the easy stuff, cash and publicly traded stock, and one for today we'll focus on cryptocurrency, but also real estate, other business. And you'll see in the sort of bottom part of the chart, and we'll get into this as we go. We know that private operating foundations and public charities get better deduction rules that we'll talk about for those kind of assets, cryptocurrency, other assets. So that public charity distinction, the private operating foundation versus a private foundation distinction, those are very important. And remember that donor advised funds count as gifts to public charity for this purpose. So often some of the charities that have had to think most about these giving of cryptocurrency issues are community foundations and DAF sponsors, because they're getting literally billions of dollars of crypto donated to them. And that raises a lot of these issues. So feel free to look back at this chart and ruminate on it, but I'm going to keep going. I also, thanks, Alan. I also kind of want to make sure we get two concepts. I know we're going to focus on cryptocurrency, but we can't talk about the charitable giving rules unless I kind of break apart two key things to remember. Now, I think everyone on this call probably more or less understands the difference between basis and fair market value, right? So you buy a thing for $100,000, it goes up to $2 million. Ignoring depreciation deductions for a second, we know that the basis is $100,000 and the value is $2 million. Well, some of the charitable giving rules will give you there are some situations where the deduction is fair market value, and there's some deduction where it's basis. So obviously, the same property being given, if you're eligible for the fair market value rule, you have a $2 million deduction. If you're only eligible for the basis rule, you get a $100,000 deduction. That's a huge difference in value. So that's why the sort of basis fair market value distinction is important for charitable giving always. The other part is the concept of AGI limits. I know everyone understands what AGI is, adjusted gross income. I would say the most unpleasant code section I deal with regularly is 170 and its network of percentage limitations and how they're laid out. We can kind of get into summing up some of them, but the sort of, it might be 20, it might be 30, it might be 50, it might be 60%, depending on the kind of asset and depending on the kind of recipient. Well, let's just make sure we at least understand what we mean by AGI limit, right? So if I make a gift of $1 million, if I have $1 million of AGI in year one, and I make a gift of $500,000, how much of that am I going to get a deduction for? Well, it depends on the AGI limit. If the AGI limit that applied based on the kind of gift it is and who it was going to was 30%, well, I may have given $500,000, but I only get a $300,000 deduction. So I'm going to have to pay tax on the full other 700, even though in my head I'm saying, well, I gave 200 out of the way. Why am I still paying tax on that income? The other 200K I can roll over for up to 5 years, so I'll eventually get to use it. But I'll have some tax I wasn't expecting in year one if I'm not familiar with the AGI limits. Conversely, if the gift I'm making qualifies for the 60% AGI limit, I could take the full $500,000 deduction in year one. So when you're planning gifts of cryptocurrency or gifts of anything else, you're always thinking about, is this going to qualify for a fair market value deduction or a basis deduction? And two, is that going to, what are my AGI limits going to be? And very often you'll see, we've worked with donors on really major gifts, and often you're sort of layering the gift by the amount of AGI limits you have that year in terms of what charity it can go to. So these things often, there's always this question about what drives charitable giving. Is it philanthropy or is it tax benefits? And of course, it's probably both. But I'll say the precise amount often relates to tax benefits, because often people are, if you want to make a big gift, you're probably not going to exceed those AGI limits unless you have another plan. let me see. So those are the key concepts. So let's start rolling into how they apply to cryptocurrency. Let's say I have $1 million worth of Ethereum I bought 2 years ago for 100K. Well, what kind of asset is it? It's not currency, so forget that. It's a capital gain asset. I've had it for 2 years, so this is long-term capital gain property. Let's say I want to give it to a private foundation, a non-operating. I'll pause a second because I'm kind of taking for granted maybe the private foundation, private operating foundation distinction. Your average, private foundation, the Gates Foundation, company foundations, the ones that their function is to have a bunch of money and grant about 5% of that money a year, that's your standard private foundation. I would say most 80%, 90% of private foundations are private non-operating foundations. So those are not only are they subject to the harsh private foundation rules, they are also subject to less friendly deduction and charitable giving rules. So if you don't generally choose to be a private foundation because you want to be, it's usually because you're the only one funding it and all you're doing is making grants. For privately funded entities, if they do enough direct activity, they can be a private operating foundation, which moves them from the left side of this chart to the right side. So I won't belabor that anymore, other than just to say that concept's going to come up a bunch, and something that you may want to think about if you have someone who's founding a foundation. If the more favorable rules are important to them, they may want to be thinking about, can they qualify as an operating foundation? Let's assume you didn't do that and you got just a lousy old private foundation. Well, the private foundation rules, except for cash and publicly traded securities, the only deduction you get is basis. So you're not getting a $1 million deduction for your $1 million of Ethereum, you're getting $100,000. And on top of that, it's only deductible up to 20% of AGI, not 30, not 50, not 60. And so, you would have to have 500K of income in that year to even use your relatively measly $100,000 deduction. So that's sort of the downside of being a private foundation. If you manage to have a public charity, either because you're giving to an existing public charity, you're giving to a donor advised fund, or your client's private foundation has qualified as a private operating foundation, you'd be eligible for a full fair market value deduction. So that's $1 million deduction. Now, it is still subject to the AGI limit, but the AGI limit's a little bit higher for these. It's 30% instead of 20%. So if I happen to have $3 million of income, et cetera, I'll be able to, use up that million. Otherwise, I'm going to roll it over for 5 years. So most of that are just sort of general principles, but just remember, donating crypto is a long-term capital gain asset. Your client wants to donate, you kind of need to understand these two charts so you make sure they're giving it to the right kind of charity and they get the tax benefits they want. I'm going to change the facts ever so slightly here, which is changing the word 2 years to 2 months. What does that do? Well, this is capital gain property, so now it's short-term capital gain property. Private foundation still limited to a basis deduction, 100,000. That's no good. It's deductible up to 30% of AGI. Let's not try to understand why it's different. And rolled over for 5 years. Conversely, public charity is still more favorable because they have that 50% AGI. But when it comes, even for public charities, when it comes to short-term capital gain or ordinary income property, the default rule is a basis deduction. So, how long your client has held the crypto for is really important when it comes to charitable giving. Any questions I should take here, Alan, you think? Any questions you have at this point?
No, I think you're doing great. I think you're doing great.
We'll keep rolling, because now I'm going to start getting into some of, these are all sort of broadly applicable. You could use this as sort of to apply to all kinds of charitable giving scenarios, but they come up for crypto specifically. The thing about charitable gifts is when people are giving something other than cash, they're usually giving it at a moment that they think is the highest value and that they expect the charity to sell. And that's all fine, because you know what the charity wants to do? Sell. They don't want to hold on to your crypto. They don't want to hold on to your picture of an ape. They want to just sell it and get the money and put it in their, in their investment pool. Let's say donors giving $1 million of Bitcoin, $100,000 basis to charity. We always need to think about the assignment of income doctrine. The assignment of income doctrine says that if you give something that is practically sold before you give it, you didn't give the asset, you gave the sale proceeds. What does that mean? Well, that means that you pay the gain as though you sold it yourself, and you're treated as giving a donation in cash. And remember what I said, the whole point of so much charitable giving, it's not about the deduction, it's about not paying the gain on the appreciation. So, flunking an assignment of income test can really defeat the purpose of charitable giving. I've seen very, very, very large deals go through. Someone, for example, a major merger where this multi-billion-dollar company was being bought out by another multi-billion-dollar company, and the founder had all this stock, and at the time they gave it, the question is, well, is this merger done or is it not done? Because if it's done, you have all the gain on that stock, and you're not going to want to, you may decide how much you're going to give it away, because you're going to have a lot more income this year than you thought you were going to have, and more tax to pay if you give it before the sale is done. And we'll talk about the test is in a second, but let me just the two basic scenarios there. I won't walk you through them. They're more or less what I just said, but I think when you get to the bottom line, notice how different the two scenarios are. In one situation, you not only have avoided all the gain, you have that full deduction for the value. That's the perfect charitable gift is one that completely avoids gain and gives you the full fair market value deduction. In the second scenario, yeah, you got the $1 million of deduction, but you also got 900 in gain, which is going to offset it. Now, okay, you're not going to and you can only use, in that scenario, you can only use some of it. Even if you could completely offset it, you've still lost the opportunity to use that deduction to offset other income. So it does make a big difference. And so in terms of what the test is, and for crypto, I think this is actually relatively easy, but if you have clients donating real property and other things, good to remember. The test is whether at the time the donor gave to the foundation, to the charity, could the charity be compelled to sell the asset? And so if everyone knows and expects that the charity is going to, so that's not an assignment of income problem. It's just an expectation. If the charity started talking to people that might sell it to, that's not an assignment of income problem. If there's a binding binding contract on the real estate you're donating, now it is a problem because the charity could be forced to sell under that contract. This comes up with merger a lot, comes up with real estate. Luckily for crypto, it's actually pretty simple. Let's go back to what crypto is. Crypto is a giant decentralized database of who owns it. And so you always know who owns crypto. It's right there in the blockchain. So at the moment of donation, were you the owner or were they the owner? So be careful to have any other sort of contracts. If there's sort of a sales contract for the crypto, anything like that. But as long as you're avoiding all that stuff, I think it should be very easy. I do generally recommend, maybe this is just a lawyer's bias where we always need to see a piece of paper. The thing about crypto is it all happens in an undocumented, unreported way. So it's like very hard for me to be like, well, what day did you give the crypto? Well, it's in the blockchain. I like a nice gift agreement assignment. I hereby give on this day. I'll do the things I need to do to transfer. So, just because, crypto doesn't necessarily require paper in itself doesn't mean you can't paper it up a bit, because I always find that to be helpful on audit. And let's apply the assignment of income rule. We already did it a little bit, but let me give you a common situation that I've actually dealt with a few times on the charity side. What's become very common the last couple of years with this NFT, let's say fad, or maybe you're more optimistic. All these NFTs there's a lot of charities that are saying, well, so-and-so is donating this somehow really valuable NFT and we're going to sell it. And then we're going to use the proceeds for charity, and then the celebrity will pitch it. I'll give another example. When I just sort of searched random celebrity NFT, and I got this one, which was Tony Hawk donating his last ollie as an NFT. So an image of Tony Hawk doing his last ollie. He donated to charity, and the charity would sell it to for all the proceeds to go. So let's pretend it sells for 1 million, and we'll get into logistics in a minute, but that a broker handles the sale and just transfers the money to charity at the end of the day. And generally speaking, if you're, especially on the charity side, if you're getting involved in crypto, the more you can outsource, the better. Coinbase, Giving Block, all these things are good ways to outsource. The critical tax question is who's the seller? Because remember, I said that if Tony Hawk sells the NFT and donates it, or gives it to someone else and tells them to sell it and donate it, that's a very different tax result. Now Tony Hawk has $1 million in gain. I can't imagine there's any basis to this NFT that he just created, and he gets an offsetting deduction, but subject to AGI limits. Contrast that with if you give the NFT to to the charity, and the charity is the one that engages the broker to sell the NFT. Now Tony Hawk gets a gift of the NFT. Yeah, it works. It's, you know, it may be a lower AGI limit, but there's no gain at all. So whatever deduction he gets, he can use that to offset other things. So I can tell you, I mean, we had a celebrity client that was announcing a big accomplishment of theirs and wanted to launch a whole bunch of NFTs that were going to be, you know, auctioned off by their affiliated charity. And it all came down to that contract with the broker. We had to spend a lot of time making sure it was right, that because the broker is an agent, right? They're selling the NFT, the crypto on your behalf. Well, who are they? Who's the principal? Because if the piece of paper on the print, it says the donor's name is the principal and it's authorizing the sale, well, then they're selling it. And that's a big taxable gain followed by a donation. If the charity is the principal on the contract, now we have a gift of an NFT followed by a sale of charity. Charity doesn't pay tax. So all that being said, this is sort of a particular application of the assignment of income rule. It happens in many situations beyond cryptocurrency, but this is the situation where it's actually coming up quite a bit in the cryptocurrency context because people aren't usually thinking about this. They're doing this as a big sales promotion. I could also talk about commercial co-ventures and CC those rules and how they might apply to these kind of auctions, but that's a different conversation.
Carl, what is an NFT?
An NFT is a non-fungible token. I'll flip back to that definition for a second because non-fungible tokens are these typically associated with artwork or picture. I gave you some examples of, you know, the best thing you could compare them to, Alan, is sort of like the baseball card market, right? They are things that have value because other people think they have value. And if I think that this NFT is going to go up in value, I might buy it and hold on to it and sell it. So Top Shot is on there. Top Shot was I think still is a NFT creator that just created NBA highlights, and you could buy the NBA highlight you liked, and because you thought this player was really cool, and if it went up, you could sell it later. And this was a whole active market for a while. And like I said, this is the kind of thing that all sounds a bit crazy to us. But there's millions and millions of dollars flowing through the NFT market at all times. So we all kind of have to understand that, like, this is going to come up. Your client is going to have a stupid picture of an ape that he wants to donate, and he tells you it's worth $1 million. And you're going to say, okay, well, what do I need to do? I need to make sure it's transferred to the charity before the charity sells it. And how am I going to do that? I'll talk about the non-fungible part of NFT that's maybe worth zeroing in on. So non-fungible, it just refers to the idea that it's entirely unique. It's not like, I don't know, I mean, in the context of Bitcoin or something like that, it might be fungible. It might be all Bitcoins are the same, let's say. I don't really know if that's how Bitcoin people would say it. But with non-fungible token, the idea is that this data entry is the only one of its kind and can't be sort of replaced with any other. So you have a unique database entry that you own the picture of this ape or one of these things or one of the sort of NFTs these services create. And like, so tons and tons of this stuff. And I guess, I don't know if it's a fad or if we'll still be talking about these 10 years from now, but for now, it's definitely something that comes up a lot. I'll skip over logistics mostly. I think this is more something that tends to focus on the charity side. And if your client has crypto, they probably know this already. When I'm often talking to charities and foundations about, hey, people want to start giving us crypto. What do we need to do to accept it? And I say, look, don't be a hero. Don't try to get your own don't try to have them donate the keys and write down the keys on a piece of paper and put it in a filing cabinet. Just create a wallet on Coinbase or create a same with Giving Block, and these are charity. They'll help you facilitate the crypto gift. Sometimes people who have a lot of crypto have strong feelings about these platforms, and I've had to talk to people setting up their foundations, encouraging them because they really just wanted to hold the keys themselves and not outsource it to a vendor. I don't love that from a fiduciary standpoint on the charity side, but we'll table that for another conversation. Alan, your question, what are NFTs? I think this might be another useful segue. And it's both as an excuse to talk about how the giving rules for NFTs work, which are the same. To be clear, the rules for NFTs are the same as gifts of crypto, same concept, a capital asset. Versus, we can also take a quick reminder of how the deduction rules for artwork and intellectual property work. What is an NFT? I'll tell you what it's not. It's not tangible property. If I buy this NFT below, I can't show up to the Louvre tomorrow and say, I'll be taking that. That's my Mona Lisa. I'm going to take that home. I don't have any rights to possession. All I have is sort of, you know, the NFT itself. An NFT is not copyright. I could, if I bought this, it will not give me the exclusive rights to produce films in the Mona Lisa cinematic universe. Mona Lisa is in the public domain, but if it were an actual thing that was owned, I couldn't start copywriting it. It's not intellectual property. It's intangible, but it's not intellectual. One kind of amusing anecdote that came up recently was there was this DAO, which is a whole other conversation we can talk about, with decentralized autonomous organization, which is sort of organized through the blockchain. And they raised a bunch of money to buy an original copy of Dune, a big like old book copy of Dune. You may have seen this in the news, and I think they spent about $3 million for it. And you'll see about part of their plans. Well, what are you going to do now you bought Dune? Well, we're going to start writing screenplays. We're going to start publishing, all the things to start doing Dune stuff. And of course, what that misunderstands is just like an NFT is not copyright, the tangible property is not copyright. It's like you may have spent $3 million on that book, but Warner Brothers still owns Dune. So you're not going to be making any screenplays or TV shows or anything of the sort. So just like that, buying an NFT with an image of an artwork, it's not the same as buying the artwork. An NFT is a capital asset. An NFT is a thing that you buy that says you own it. And really, getting back to all of this with crypto, with NFTs, you're buying it because you think that someone else might pay more for it later. And whether that logic is rational, it's the same thing with our baseball cards are inherently valuable. No, they're valuable because someone else might pay for them, or a coin collection. You got to kind of think of it like those sort of assets that it may not entirely make sense why it has value, but if someone else thinks it has value, it's an asset you could donate. To recap kind of what those rules are, and I won't spend as much time as I usually might because I want to get to some other stuff. I'll just leave this chart here. You see that all three of these categories kind of have some weird rules to them. So IP has, when you donate IP, there was a problem where people were donating intellectual property they claimed was valuable but was not. And so the IRS created a rule where, look, if you want a deduction for IP, we're going to tie it to the actual money the charity gets from it. So you say you have a basis in a patent of $100,000. You say it's worth $1 million. You get the appraiser to say it's worth $1 million. But we're just going to say we'll give you a $100,000 deduction. If the charity makes $1 million, you can have that deduction. But and it's a complicated formula. Tangible work of art, when you donate that, there needs to be a related use. Otherwise, you're going to get a basis deduction. That's important. But NFTs, remember, are just like crypto, which means that if it's long term, it's fair market value to a public charity or private operating foundation, and it's basis if it's a private foundation. We'll get to these rules in a second. AGI limit. I do want to make sure we talk about substantiating the gift. One of the big overlooked things in my mind for all charitable giving, but especially for cryptocurrency, is the substantiation rules. Reminder, cryptocurrency is not currency, and it's not publicly traded stock. So the substantiation rules apply, which means that if you give something that's more than $5,000, including crypto, you need to file a Form 8283. You're going to have the charity countersign that to confirm that you gave. That 8283 is going to attach a qualified appraisal by a qualified appraiser. And you really need to make sure you have both of those things. There are relatively new regs, a few years old, that get into very specific requirements for what a qualified appraisal needs to have. I'll tell you, when people send me appraisals that they claim are qualified appraisals, I can't think of a time where I haven't had at least one comment about what you need to do to make it a qualified appraisal. There's specific language that needs to be in there. And now, in practice, I'm sure many people get by, but remember that what the IRS has this requirement is a tool in its toolbox for when it doesn't like the value you took, it doesn't believe it, but it doesn't want to invest the resources in a billion experts to argue with your billion experts about how much your crypto is worth. It's going to say, look, you don't have an appraisal, or your appraisal left out the magic sentence, so not a qualified appraisal, you lose the whole deduction and we don't have to argue. So people need to give more time to making sure their qualified appraisals are good if they want to manage the audit risk. And also there's note that the charity has a filing obligation if it sells something it got a Form 8283 for within 3 years. That's the way of the IRS finding out that, hey, you told us this was worth $1 million, the charity sold the next year for $10. Are you sure it was worth $1 million? Now, so it's sort of an audit prompt for the IRS. And you might say, and trust me, every client I've told they need to get a qualified appraisal for cryptocurrency has said, but it's actively traded on Coinbase. You can look it up, just like you can look up the price of Google stock or Netflix stock. You can look up the price of Bitcoin or Ethereum or all these things. So why do I need to get an appraisal? So clearly, if it's on Coinbase, surely I don't need one. Doesn't matter. You need to get a qualified appraisal. There's no exception. I would say that appraiser has a very easy job. All they need to do is probably go to Coinbase and say, well, this says it's $10. I could sell it for $10, so it's probably worth $10. But it is, you still need to get that qualified appraisal, or the IRS can knock out your deduction. You might say, what if the crypto is a stable coin? If at this asked, a stable coin, in this one case, it was a coin that no matter what, by formula, is always worth exactly $1. My reaction was, well, why do you need this? Why don't you just have $1? But that's not the kind of question you're supposed to ask. He was like, well, surely if I have $1 million of stable coin, it must be worth $1 million. And the answer is, does not matter. You need to get a qualified appraisal. There's just no way around it for anything other than cash, publicly traded securities, or certain property that has a carve out under the code. I'm gonna mostly skip over recipient issues, but I am gonna say read this at your leisure, because I want to make sure we get to the sort of scenario that Ellen, you teed up, because I think it's a really good way to kind of tie back all these issues. Just remember that if you have a foundation, if you're representing the foundation or the charity, you have a prudent investment issue. Generally speaking, charities don't get to go, what I tell clients is, like, when you have your money, you get to have all the fun with it you want. Go on a roller coaster ride with Bitcoin, it's fun, right? When you have a charity, the AG is not the Attorney General is not a fan of you taking charitable money on roller coaster rides. Generally speaking, not what they want. This is enforced under both a MIFA, which is state rules regarding how nonprofits can invest their assets, and under the jeopardizing investment rules in 4944. Now, that's the standard, and so that's definitely what I tell charities when they want to take their own money and start investing in crypto. This isn't for you. This is maybe perhaps as a percentage of your overall assets. If institutional investors are taking 5 or 10% in sort of the crypto market, then maybe you can do 5 or 10%. But it's not for day trading. There's a little bit of a different answer if it's being donated, or at least we have a little more flexibility, and I often encourage donors to take advantage of this flexibility. For one, 4944, the foundation rule that says you need to prudently invest or we hit you with taxes, doesn't apply to donated assets. So automatically, the fact that you donated Bitcoin says that the charity is not going to have a private foundation rule problem with holding onto that Bitcoin. There's also, under a MIFA, the donor can waive the standards under a MIFA, including the expectation to diversify. This is useful for crypto. It's also used for any number of other closely traded assets where the donor has sort of a unique idea that the charity is going to hold on to this and keep it for a long time. Even if, under nonprofit law, you would say, well, this charity should really diversify. The donor can waive it. I would say there should be limits to this, but this can be very helpful. We had some community foundations out here in California that received billions of dollars of crypto. So their assets were worth, let's say, 20 billion instead of 15 billion. But then next year, they went down to more like 16 billion. And so the AG would look and say, well, it sure seems like you lost $4 billion of charitable money. What happened? And having things like this, it's helpful, at least under the law. I'm going to skip over the securities rule, the UBIT rule for the most part. The bottom line takeaway is just crypto mining is probably UBIT. If you don't know what crypto mining means, if it comes up, remember, it's probably UBIT. Generally speaking, though, just selling crypto is going to be a capital gain. There is some ambiguity in this area. There's a little bit of recent developments and stuff, but I think the safe answer is crypto mining is probably an active trader business. Securities law, really important for nonprofit recipients, not all that important for donors, so I'm going to skip over it. And let's talk about, and I hope the slides look okay, kind of the strategy. Ellen, did you want to intro this, or do you want me to jump in? What would be useful for you?
No, I think you're doing great.
Yeah. So I mean, there's all kinds of cryptocurrency, and DeFi tokens are one. I'm not going to pretend to be an expert on exactly what they are, but my understanding is a lot of people who are really into crypto like the idea of sort of engaging with financial instruments in crypto form as opposed to in their traditional form. And so a token could represent sort of a financial instrument. So you might have this financial instrument, which is probably very appreciated in our scenario. You know, that brings up sort of other classic charitable planning techniques like charitable remainder trust and charitable lead trust, also potentially estate planning vehicles to use them, but you have to use them intelligently. Because remember that the thing you don't want to do is sell that token or cause a recognition of that token's gain, or you're going to have a lot of income that you're trying to avoid or defer. So often, you know, these tokens usually, and this is true of all kinds of cryptocurrency, usually whatever the thing is donated is converted to commonly traded crypto, like a blockchain, Ethereum, on a platform like Coinbase, and then it could be turned into cash, or it could just be sold for other crypto. This is probably, I've had clients ask, well, wait, why can't I just do a 1031 exchange of my token for another crypto similar asset? IRS has said no. Crypto is not eligible for 1031 exchanges. So if you had that clever idea, congratulations, but the IRS has already ruled it out. So we need to talk about, well, how could we sort of, you know, transfer these cryptocurrencies in a way that doesn't trigger tax and in a way that sort of accomplishes some of our classic charitable giving scenarios. And let me just kind of flip through just to remind myself. Yeah, okay. So the following, you know, so we can do, let's say you own a DeFi token. And one thing that can be useful is to create an LLC. Why? I think you'll see sort of what the function of the LLC is here in a second. But LLCs can be useful, particularly when it comes to giving to charitable remainder trusts. And maybe let's pause and just remind ourselves what charitable remainder trusts are. I could riff on this for a while, but like, let's try to focus on the key things. Why would you create a charitable remainder trust? Well, kind of two things. You want money to eventually go to charity, but you're not in a rush to give it to them. This is very common for couples without kids. Sometimes you'll have the couples without kids. Well, look, I know I'm going to leave everything to charity anyway, but I don't really get much of a, you know, maybe I won't get a tax benefit when I die. You know, I'm not worried about estate taxes. You know, what do I do to get some sort of income tax benefit from the fact that I plan to eventually give to charity? It's kind of what a CRUD is. It gives you a chance to participate in the tax benefits of your deathbed generosity during your lifetime. So when you have a CRUD, the gist is you donate to a CRUD. A certain percentage of the value of the trust will be distributed out to you each year during the term, which is typically your life or your life and the life of your spouse. And it'll make these payments. So you'll get X percent per year. What are the tax benefits there? Well, when you give to the CRUD, let's say I give my $1 million to a charitable remainder trust that's going to pay me and my spouse 5% per year, and then at the death of our survivor, go to favorite charity. A few things happen. One, I get a charitable contribution deduction for the value of the actuarial value of what that charity is expected to get. That actuarial value needs to be at least 10% of the value of what I'm giving. If you're trying to max out the benefits, so I guess it would probably be about 10%. So you're getting a deduction that's small. In my example, let's say the remainder interest was 10% and I'm donating $1 million of crypto, I am going to get a $100,000 deduction. Not bad, could use it for things. The other key benefit that we've talked about a few times is I am going to, let's assume I was otherwise going to sell that token, I would be paying gain on that tax. If I donate to the CRUD, it doesn't exactly happen that way. It's not completely tax eliminated, but it's certainly tax deferred, and with some degree of tax avoidance as well. And we'll talk about why. So where does the LLC fit into all this? Well, LLCs can be useful for facilitating gifts to a charitable remainder trust. If I have a bunch of things I want to give a charitable remainder trust, or an asset that's a little tricky to transfer, maybe like a DeFi token, if an LLC owns the DeFi token or owns the other assets, all I need to do is transfer the LLC. That's one reason we might use an LLC, and we'll see this as we go. Another reason to use an LLC is sometimes as what's called a blocker LLC or a spigot LLC. These refer to LLCs, and let's back up to the concept of a charitable remainder trust. So one kind of charitable remainder trust is what's called a net income charitable remainder trust. A net income charitable remainder trust pays you the lesser of actual income and 5%. And you might say, well, why would I want to be paid less? Less is bad. Well, you're allowed to have it so that it could be less for a certain number of years and then eventually catch up with a big distribution at the end. That's called a net income makeup CRUD. And that's the kind of CRUT I do. So I always talk about CRUTs in two ways. When I'm talking to charities about CRUTs and their planned giving programs, they're offering standard CRUTs. It's always 5%. There's no fancy makeup provisions, none of that stuff. We'll just pay you 5% per year. When I'm talking to donors who really want to maximize the benefits of a CRUT, I'm talking about net income makeup CRUTs, because what they let me do is keep as much income in the CRUT as possible for as long for my lifetime until I'm ready to start taking money out. And then when the money comes out, it's coming out on a tax deferred basis. It's been growing tax free all that time, and now the distributions to me are going to be much larger. That's a recap of the benefits of CRUT, but just to make sense of this. So here we know your donor has a DeFi token. They're thinking about giving to a CRUT. Step one is let's have the LLC own that DeFi token, create a wallet in the LLC's name. And I agree that I think, again, the nice thing about crypto and DeFi tokens is what they are all about, the record of who owns them. So if the record says the LLC owns it, the LLC owns it. Step two, you transfer ownership of the LLC to the CRUT. So this is also good because all I need to do is write an assignment. I hereby assign the membership interest in the LLC to the CRUT. And by doing that, I have effectively donated the DeFi tokens. Remember, the LLCs are disregarded entities for tax purposes, so that the CRUT is going to effectively just receive a gift of this DeFi token. Careful though, when you do qualified appraisals, if I were getting a qualified appraisal for this donation, I'm getting a qualified appraisal of both the DeFi token and I'm getting it for the LLC. And really, what is the value of the LLC? Well, it's just the value of the DeFi token, but I need to make sure my appraisal says it's appraising the LLC so the IRS doesn't catch me by surprise and say, you got a qualified appraisal for the wrong asset. You gave an LLC. Just be prepared for that. But so we have the donor, we have the LLC, they're transferring the LLC to the CRUT. And we know that the way this CRUT works is that the CRUT's going to hold on to that LLC for lifetime, and it's going to make these payments. Now, the problem is that you would normally have is that, to make payments, you have to make the payments in cash. But because we've moved it to the CRUT, to the extent the CRUT needs to sell to make those payments, it's happening on a tax deferred basis. So only when you have a CRUT and you receive, the CRUT itself doesn't pay income tax. Instead, you pay income tax when you get payments from the CRUT based on the kind of income the CRUT had. It's a whole complicated 4-tier system that I hope you never have to learn thoroughly. But the gist is, as this CRUT is going to have a bunch of capital gain over its lifetime, keep growing tax deferred, not pay taxes on it, it's going to pay you your 5% per year. Or if you use a NIM CRUT, a net income makeup CRUT, a whole bunch of money, a whole bunch of years from now. But that's money you would have been paying tax on potentially the whole time, especially if you were trying to liquidate. Any other nuances there, Alan, that would be helpful?
Will the LLC be a blocker when the LLC sells the Bitcoin? Then under the Principal and Income Act of that state, there's no income to the CRUT until the LLC makes a distribution.
Yeah, that's it. Yeah, let's talk about that. That should work. And so that's a sort of spigot LLC or blocker LLC concept. So when we zero in on this sort of net income makeup CRUT rule, the goal is to not have payout requirements for a long time so that you can have one big payout requirement later. Well, the problem is that if you're selling along the way, you're going to generate some income. If it was just a trust holding the DeFi in token. And so that would result in distributions you probably don't want to make because you want that money staying in there for longer to keep building up. What an LLC can do is under the state's Principal and Income Act, although these LLCs are disregarded for federal tax purposes, they're not disregarded for state purposes. And for calculating the trust income, you look to state law. And state law says that you only have income from an LLC if the LLC makes a distribution to you. That distribution is income, but the LLC itself earning income doesn't automatically result in trust income. So that can be a way to say, okay, let the income build in the LLC. My trust isn't going to have that income for accounting purposes, so it's not going to have to make a distribution, so I can keep building up. There's one thing to be careful about is if you do this, you want the manager of the LLC to be not a subordinate or related party. Under the little bit of guidance we have on this, where the IRS said this works, we know that was the standard. So you want an independent LLC, manager of the LLC deciding when income is going to the CRUT, but you're certainly hoping that good friendly manager will be distributing the income to the CRUT around the time that the donor wants some money from the CRUT. So then it usually tends to work out just fine. Yeah, so this can be useful. And like this, really, if we just think about when CRUTs are useful, well, CRUTs are useful when you have appreciated assets to spread out the income, the tax, to defer the tax over the course of your life and create a really tax favored income stream. Well, cryptocurrency is also an appreciated asset and is really useful to give both for deduction reasons and for the sort of taking advantage of a CRUT. So crypto is a great asset for giving to charitable remainder trusts. It's a great asset for giving to charities directly, to giving to private foundations. There's some things to think about in here, but overall, I mean, if anything, I think the donation of cryptocurrency is underutilized as a tax planning mechanism. And I think over the last year or two, I've seen charities start to get more comfortable. I think at first they were a little shy about taking it, but now I think charities are starting to see this picture and realize, oh, we could actually make a lot of our donors really happy by taking this and working with them on this, which will be good for both of us. So I think, I mean, at that point, yeah, happy for random questions, happy for anecdotes. I know we went a bit over, so I appreciate those of you who hung on to keep hearing me ramble about crypto.
Yeah, let me tell you some questions here. Do you have any thoughts on a charitable organization creating an NFC for either fundraising or investing?
Yeah, I mean, the way I would think about it would be sort of, to be careful about would be when you create the token, you want to be careful of the charity. So if you're offering, I skipped over the securities law presentation, but I can tell you that question would make securities lawyers a bit nervous. If you're creating a token to offer to donors to buy as a way of supporting. What I would say is if you are creating an NFC to sell, and it's not tied to the value of the charity, it's just sort of like maybe it's just sort of the logo and something you get to say you own this thing, that kind of thing. Yeah, of course, I think that would work just fine. Remember that, yeah, the charity's selling it. Maybe that's ordinary, maybe it's capital, but we don't care because it's a charity. And so I think you're in great shape from that perspective. And so, yeah, I think if it's as long as it's in that category of just like selling a t-shirt or selling a mug, if it feels like that, that's great. I have seen charities come to me trying to sell tokens that sounded a lot like sort of an offering in a fund or an offering in sort of the value of the charity, and that would make me nervous from a securities perspective. Remember when I talked about securities law, I didn't mention, there are some securities, some tokens that are considered very safe, clearly not securities, so we don't have to worry about securities law. But there's been a giant SEC enforcement action against Ripple for a long time. And that's winding down, but there is risk when you're doing sort of initial token offerings, initial coin offerings, you don't structure them right, that you could make securities regulators unhappy.
And then here's one from Lee. What has been your experience with Coinbase for settlement? Lee's aware of 3 estates that have been waiting for extended periods of time for response or distribution. All requirements have been met, but in one situation, it's over 14 months. That's a little scary.
That is scary. Yeah, I haven't run into these issues. I will say the org I work with, again, some of the charities I don't know what Giving Block offers on the estate side, but all the charities I worked with have been very helpful for that. I haven't done, I'm past the point in my life where I do the trust administration, so I haven't run into that. Doesn't surprise me. I think Coinbase is trying to keep up with an explosion of growth and an explosion of regulatory scrutiny. So I think perhaps it's just sort of an adjustment period for them as they ramp up, or perhaps it's a sign that maybe you need to shop around a bit.
Okay, then here's one from Stuart. Where can I find an appraiser who appraises cryptocurrency? Is there a database for them?
You can look around. So I have a few referrals that I use, and feel free to follow up, and I can give them to you. But I do think that anyone that's you've been using for sort of business appraisals, I think people are recognizing this is easy money. This is these crypto that you don't really have to do much, and so I don't think it should be hard to find. I would say use an appraiser you would trust for any other asset and ask what they would do. Are they willing to do it, or do they know someone? Because what matters to me, it's really easy to appraise the crypto, at least for most of these kinds of crypto. What is a little harder is heart of it rare is the appraiser that actually knows what needs to be in the appraisal to satisfy the requirements.
Okay. Now, on the concept of the LLC being a blocker, so the LLC owns the crypto, the LLC sells the crypto, the charitable remainder trust doesn't recognize the income yet. Does it matter what state the LLC is formed in?
That's a good question. I haven't run into a. I'm in California, and we're comfortable here that it works. I haven't run into a state where that's an issue, but I do know. I think California has changed its principal and income act like 7 times in 7 years. So I think it is something to pay attention to. And so I don't know if you know out of any states that don't work, but I would say every time I do one, I go and look at the principal and income act just to make sure I still feel good about it. Yeah.
Right, right. Okay, well, that was fantastic, Carl. I thought you did a great job. We've got 156 people who stayed till the bitter end.
Wow,
And,
that's greatly appreciated.
Yeah, my only question is, when can you come back and do and show that one slide that you started with, the Carl Mill comprehensive view of charitable giving? When can you come back and present that for us? Any Saturday at noon.
Yeah, we're doing a 2-part. I know we're doing a 2-part session on the CPA Academy during I don't know if you have the dates in front of you, Alan. I could probably find them. I think one was February 15th.
Yeah, I'll have Kelsey send everybody.
Yeah, that'd be great to send that around.
But if you could come back on because that's for CPAs, but if you can come back and give a layman's talk.
Yeah, would love to. We'll get something set up. I would love to break down that chart. It'll give me an excuse to keep honing my unified theory and making more flow charts.
Yeah. So for all the attendees, you've got Carl's email address there, karl@mill.law. And I'm Gassman@gassmanpa.com. Send me the easy questions, send Carl the hard ones, and we'll be more than glad to answer. We learn a lot from questions. And Carl, thanks again. Thanks to everybody. I hope everyone has a fantastic rest of the day.
Thanks.